There we are.
Good morning to everyone. I guess if you're Central Time, it's noon. Mountain Time, it's 11, and if there's anybody East Coast, that's 1 o'clock now. Welcome to our monthly Oxford Wealth Market Update. I am Lynn B. Thurgood, CEO and founder of Oxford Wealth Advisors, and we're glad to have you join us this morning for a few updates and some information that we hope will be beneficial to you. Let's go ahead and just today's title is Banks, Markets, and Government Default. Oh my. Anyway, we're going to deal with a few of those issues here just briefly, and let me go ahead and get the screen progressing here. There we go. There's disclosures. Gage, again, cue me. Are we okay still so far?
Yes, sir, you are. And Tim has joined the call as well. So just for your information.
Oh, that's awesome. That's
Hi, everybody.
awesome.
Sorry I'm a bit late.
Tim, welcome. We'll bring you in here in just a couple minutes and introduce you properly. So disclosures, as always, we are not, what was I supposed to say? We don't give legal or tax advice. We're investment advisor representatives through the TownSquare Capital and Portside. We'll get into those things, changes that we've been talking about over the last little while. And we're an independent entity. Changes in the air. Boy, oh boy, isn't that the truth? Change is everywhere. And so let me address the TownSquare Capital and Portside Wealth. We addressed this last month. I want to do it again. And then, of course, the TD Ameritrade and the Charles Schwab. Those of you that have what we refer to as yellow or red money, that's our low risk or managed money that is with the custodian TD Ameritrade or Schwab. And of course, TownSquare Capital was our investment advisory firm and doing all of our trades and management of the assets. They recently refocused strictly on trades and management, and Portside Wealth is now our investment advisory firm that basically we just handles our licensing and compliance and support there. So there's the new graph. Oxford Wealth, we're the folks on the front line that have the pleasure of visiting and working with each of you individually. Some of you on the call are not currently clients of the firm. Most of you on the call are, but that's our diagram for that type of business. As you know, we talk about green money, yellow money, red money, and this is all on the yellow and red. Oxford Wealth and Portside is our investment advisory firm. You've been getting some mail and communications about that over the last little while. And then, of course, TownSquare Capital maintains its role in the investment management and trading and everything else relative to that. The custodian, primarily for most of you in the past, has been TD Ameritrade. That's now going to be merging into Charles Schwab. TD Ameritrade and Schwab nationally are merging. I think the official date is about September of 2023. So that's what's going on in relation to change. No changes in your fees, no changes in the managers, no changes in our relationship. It's just changes in who you're going to get mail from. So business as usual there. Just a quick review. Okay. Let me see here. I want to take just a minute now. We have a lot of folks that are behind the scenes, and I wanted to just give them an opportunity to say hello to you on the call today. Miss Michelle Phillips has been with our firm since September of 2010, and she is lead on our investment team processing and service. So those of you that have the yellow and red money, she is the internal here that takes care of everything relative to servicing and changes and updates, and she is part of the firm. Michelle, are you on the call?
I am. I'm here.
Okay.
Hey,
You see a little
folks.
picture of her there. Just there you go. There's the intro. You wanted to share just a little information or two about you?
Oh, just some personal information. My favorite thing to do is to spend time with my grandkids. So that's what I'll be doing later on this afternoon.
That's great. Super. We're glad to have her part of the team, and she gets it all done and has been with us for a good while there. Okay, thanks, Michelle. Miss Trilby.
Hello.
Trilby works in our fixed department and helps. Yes, we can hear you. And she works with our fixed assets, green money, and has been with the firm since July of 2016. So we're glad to have her part of the team. What little factoids do you want to share, Trilby?
So my husband and I will be married 5 years next month, and we have 2 cats, and we do a lot of jigsaw puzzles in our spare time.
I'm a jigsaw puzzle guy off and on myself, so that's great. Thank you, Trilby. We're glad to have you on the call here with us. And now we'll introduce Miss Kiri Greathouse, and now she has an additional last name. She's been with our firm since November of 2019. Kiri, what do you want to share with us?
Yeah, fun facts about myself. I was an ancient Greek major in college, so finance was an interesting world to find myself in. And as you kind of just said, I got married last week, so still pretty new.
Yeah, she's a junior advisor with the firm, started on our front desk, a receptionist role and support, and has progressed and has shown some great aptitude in financial and such, has gotten all of our licenses. So we're glad to have her part of the team, and congratulations, Kiri, on your marriage. That was not quite a week ago, right?
Yep.
Okay. Crazy her. It's like, wait a minute, honeymoon? I mean, a week or two? Come on. She's getting some time off, I think, the end of May, so that'll be good. All right, who's our next folks? Mr. Kevin Rigg, CFP CFA, joined our firm December of last year as a junior advisor, has been in the industry quite a few years. Kevin, what do you want to share?
Well, I grew up in Los Alamos around the crazy lab scientists. I moved back to northern New Mexico last year to help my folks as they transition into a new stage in life. So I'm a classically trained financial analyst. I can dig as deeply into the weeds as you like, or we can just stick to the basics and keep it simple. And that's it.
Great, Kevin. Welcome aboard. And Brenda joined us in March of this year, and you might notice the same last name as Kevin. So she's working in our fixed business support and also receptionist role, new to the firm. Brenda, take it away.
Hi, I'm on Trilby's machine.
Okay.
What take it away.
Yeah, take it away. It's all yours. What do you want to share with us? No, you get like 30 seconds. Go.
Let's go on a trip to Glacier. That's my favorite spot. I'm from Montana originally. I'm loving New Mexico though. I'm enjoying like very light, slow snow winters. So it's been a nice place to be.
Great. Well, welcome aboard. Glad to have you with. And finally, today we'll introduce you to Sydney Phillips. You'll notice a similar last name there with Michelle. Sydney joined us in March of this year as well on the investment side, support and also receptionist duties. Sydney, go for it. What do you want to share?
All right. So can you hear me?
Yep.
Okay, perfect. A little bit about myself. I graduated college back in oh my gosh, it was just like 2022 actually. I have a daughter. She's turning 2 in July. She's kind of my life. I don't really do much else other than take care of her and dote on her. But yeah, I don't really have much else going on.
Full-time job right there.
It really is.
All right. Well, thanks for joining us. And again, these are people behind the scenes. I just wanted everybody to have a little introduction to them because they do a lot of work. They keep us moving and rolling forward. you know, the advisors that you're all familiar with are on the front line and you get to interact with them quite regularly. But behind the scenes, we've got a tremendous team and a lot of work that gets done, and we appreciate all these good folks that are part of our team. All right, we're going to transition now on our topic. We're going to introduce you to a gentleman by the name of Tim Holland. He's the Chief Investment Officer with Orion OCO TownSquare Capital, and we're going to have him share some insights, market related, for the next 10-15 minutes. And here's his bio. Sorry for the busy slide there. There's just so much that had to be written, Tim, and I couldn't, figure out any other way to do it. So there it is. Maybe if you want to share a little background, or if any of you have questions, feel free to follow up with us. And I'm going to try to see if I can turn the slide deck over to Tim at this point.
Yeah,
Gage,
I
if
think
you'll assist me.
oh, sorry, Lynn. No, thank you. I think if you stop sharing, I have the slide so I can share. Hopefully I won't mess this up 3 years into this.
You're all in.
Oh boy, we'll see what happens. All right, give me, I'm going to go very slowly so I don't hit the wrong button. It's great to be with you all. Hopefully this won't take too long. And then I'm going to share my screen and hopefully. Okay. Hopefully you see my big smiling mug.
Yes, we do.
Okay. All right. Thanks, Lynn. It's nice to be with you all. I'll give you a little bit of background, and then we'll dig into some of the issues of the day. So to Lynn's point, it was great to meet Lynn and his team earlier. That was earlier this week, right? Oh gosh.
Yes, sir. It was Monday.
Wow. Boy,
Let's see what you get for meeting me. I put you to work right away.
Wow. Boy, keeping me moving, which is good. But I am the Chief Investment Officer at TownSquare. If you ever see the initials OCIO, it's the same thing as TownSquare. And I've known Kurt Brown and his team forever. I slotted into the CIO seat at TownSquare a couple of months ago. I had been Chief Investment Officer for all of Orion, which is the parent company. So I've been with Orion or prior firms since 2017, and before that I spent about 17 years on Wall Street helping manage some mutual funds and working at a hedge fund. So looking forward to working with you all and obviously Lynn and his team, and always happy to hop on if there's any interest calls like this and share our thoughts around the markets and the economy. We're living through an interesting period, so we're not really lacking for things to talk about. And so with that said, I'll click through a couple slides if that's okay and turn it back to Lynn. And if folks have questions as we go, please just unmute and fire away, or we can go through the next 10 slides or so and then take them at the end if that's okay, Lynn.
Yeah, that'd probably be better, just so we get through it all, and then we can open it up for questions at the back.
Okay, great. So I'm going to click through. Hopefully this works as well. So there's the bio. Okay, so we've been very focused on the idea of the U.S. economy heading into a recession. And we're not the only ones, right? You sort of open any newspaper for those of us who still like print, or you just go online or watch CNBC or Fox Business, and lots of smart folks are talking about a recession, including the Elon Musks of the world and the Jeff Bezos of the world. So the economy has been pretty resilient, but we do think storm clouds are gathering, and we're going to talk about that in a second. But we would also make the point that, and I apologize for telling you all what you already know, the economy is not necessarily the stock market, right? So you can have a really good year in the economy and a not so great year on Wall Street. And last year was sort of one of those years, right? The S&P 500, probably the most followed index in America, was off 18%. At one point, it was off 25%, but the economy grew about 3% for the year. So you can have these periods where the market's struggling, the economy's doing fine, and the inverse, where the economy's starting to struggle and the market's doing okay. And so even though we think storm clouds are gathering, we're cautiously optimistic on the U.S. market. And so far, at least as of today, that same index, the S&P 500, is up about almost 10% year to date, which is pretty impressive considering some of the challenges we're dealing with. So let's see. As we think about the business cycle, this is I think, pretty good visual plotting out of how this economic miracle that we all participate in works. Sort of 5 stages: peak, contraction, trough, recovery, expansion, and then you start the process all over again. So if we're asked, we think we're sort of far right. We're kind of at that peak or maybe a little bit past it. That things, even though the consumer's been pretty resilient, the jobs market's been pretty resilient, that we do think the economy is weakening, and you're starting to see more data points along those lines, and we'll talk about that in a second. The other thing that we all have to deal with, and this is really sort of a phenomenon of the last 30 years, because of global trade and the way capital, stocks and bonds and dollars move around the world at the push of a button, we live in a pretty globally integrated economy. So we're the world's largest economy. I think we're the world's most important economy by far, and the U.S. consumer is the most important economic entity, if you can sort of lump us all into that kind of bucket in the world. But if we're starting to struggle, the rest of the world's probably gonna struggle. The saying is, when America sneezes, the rest of the world catches a cold. But again, worth remembering that the economy isn't the stock market, and again, you can have one struggling, the other one not struggling. So in terms of why we think we could be heading for a recession in the back half of the year, it doesn't have to be severe. This is not sort of an 08, 09 phenomenon. For those of us who lived through that, remember that when the housing market crashed and the S&P was off 48% in 2008, and even more than that, peak to trough. So we think even if we do get a recession, it's not going to be something along those lines, but there are lots of reasons to think why the economy is starting to stumble and struggle. So the first is the Federal Reserve has raised rates over the last 15 months at a pace and to an extent it's never done before. And there's a saying on Wall Street that monetary policy, which is what the Fed does, acts with a lag, that it takes a while for all those rate increases or rate cuts to impact consumer and corporate behavior. So the Fed's taken the Fed funds rate from 0, that's the benchmark rate, to over 5%. And we think that's starting to have a real impact on loans and business activity. That monetary policy that the Fed has put into place has led to something called known as the inversion of the yield curve, where the bond market right now is screaming recession. Now, typically there's a lag when the bond market sort of shows what it's showing today, but whenever the bond market's done what it's done and is doing what it's doing right now, is you've almost always gotten a recession. Real rates are positive, which means the Fed funds rate is above the rate of inflation, which is a headwind for growth. The Fed thinks the unemployment rate is going to get near 5% from 3.4 today. You've never seen that kind of jump without an economic contraction. Lots of leading economic indicators are weakening. Housing markets remain very strong because of lack of supply, which again is great. It's not 08, but even home prices have come in a little bit. And then you've got all the awful events in Eastern Europe for sure, even if the world has learned to live with that. And then finally, and we'll talk about this in a second, the stress in the banking system is another way to think about access to credit getting even more difficult, sort of a de facto interest rate increase. And you're really seeing that impact lending behavior across the country. So a couple things that are probably worth keeping in mind around sort of the business cycle. Recessions tend not to happen. So typically my sort of default position is the economy will do well because the economy tends to do well. We've only been in recession about 10% of the time over the last 50 some odd years. So they're rare, but they do happen. They only go for about 10 or 12 months, whereas a typical expansion goes for 70 plus months. And you often see, again, this disconnect where the stock market does well, even as the economy is weakening. And even if we are going into a recession, what's worth remembering is that the markets tend to do really well coming out of a recession. So what we've plotted on the right-hand side of the slide is just total US GDP going back to 1970. And you just see that those vertical bars are periods of contraction or recession, so they're rare. The economy expands much more than it contracts, and you see even that very sharp but short pandemic-driven recession, our total economic output is well above where it was pre-pandemic, which is, I think, a miracle because a lot of countries haven't gotten back to that level and exceeded it. Okay, so the banking crisis, Silicon Valley Bank has gone away, Signature Bank in New York, and then 2 weeks ago, another bi-coastal bank, really, First Republic. And so a lot of folks are worried that this, again, feels like '08, right? The housing market crisis, what happened to Wall Street, what happened to some of the big insurance companies, Bear Stearns went away, Lehman Brothers went away. You know, we don't think the system faces systemic risk. We think those three banks had characteristics in common specific to them that led to their failure. Some of it was management's fault for sure, but we don't see those characteristics across the broader system. So at a high level, all three banks had depositor bases that were very concentrated. They had a huge amount of uninsured deposits, meaning the FDIC wouldn't back those deposits. And they had exposure to very specific industries or regions, either East Coast, West Coast, digital assets or crypto or venture capital. And they had portfolios of high quality bonds, but those bonds went down in value when interest rates went up, and they had to sell those bonds at a loss. And so when all that started to happen, one of my favorite movies, if not my favorite movie of all time, is It's a Wonderful Life. You had a good old fashioned bank run, but in this case, sort of play out on social media. So say Silicon Valley Bank, their depositors started to be worried about the bank's financial viability. Text messages, social media platforms, postings were made, and one depositor started to pull his or her money out, and then the next one and the next one. So it's like that scene again in It's a Wonderful Life where George Bailey's going to take his honeymoon money and sort of just buy enough time so Mr. Potter, evil Mr. Potter, doesn't get his hands on the Bailey brothers building and loan. That's what happened here, just not in a single room. It played out on social media, but the characteristics that led to that outcome really were specific to all three banks. The reason we think it's not systemic, two parts. You had a very robust regulatory response. All three banks have been taken over on pretty favorable terms by much stronger, much larger banking institutions. And on the left-hand side of the slide, the center text box, it's kind of busy, but essentially the Federal Reserve has put in place a lending vehicle where banks who are seeing deposits leave can borrow against those bonds they hold, even if those bonds are now worth 70 or 80 cents on the dollar, as if they're worth 100 cents on the dollar, what's known as fair value. So the Federal Reserve in particular has been very aggressive in providing liquidity and a backstop, and we think that's been well received. And then to point out again why the problems at Silicon and First Republic and Signature were specific to those three. If you look on the left-hand side of the screen, that graph, so Signature, Silicon, and First Republic had well more than 60% of their respective deposits in the uninsured bucket. So those were north of $250,000. They did not do a very good job managing their depositor base at all. And so, you know, if you're a CFO of a trucking company in California and you've got $1 million in First Republic and you're worried about the bank and you realize that $1 million is not going to be covered by the FDIC, you're going to take your $1 million out. And that's what happened. So we could see another bank or two struggle, get into trouble, but we don't think it's systemic. We don't think it's '08 or '09. A couple quick thoughts, if I could, Lynn, on what's going on in DC. And I just saw a headline where budget and debt ceiling negotiations have sort of broken down for the day. The Republicans have walked away saying that the Biden administration is not serious. So it's not to be flip. It's sort of like you don't have enough to worry about, and now you have to worry about a default. So the U.S. has never really defaulted on its debt before. There are a couple interesting historical anecdotes on the next slide that Lynn pulled together. But the big risk is that the U.S. is going to default on the bills and the notes and the bonds that are outstanding, and that is going to cause, and it could just, you know, sort of a cataclysmic series of events across global financial markets. Because even with all of our problems as a nation, we're the world's largest, most important economy, and the interest rate on the U.S. 10-year note is the risk-free rate for the world, right? Just about every other major interest rate keys off of that interest rate, and those securities that are issued by the government are considered the most risk-free investments in the world. So if we were to sort of default on that, we'd be in uncharted territory, and the consequences of that for the market and the economy are really unknowable. So again, Lynn pulled this together. It's really interesting stuff. I just noticed Alexander Hamilton tearing up in the upper right-hand side. Huge fan of the first Secretary of the Treasury. He did more by the age of 25 than I'm probably going to do by the time I'm 100. But I'm working on it. So there were 3 times when we sort of didn't keep our financial word. The war with the British, War of 1812, 1814, just didn't make some payments. In 33 and 34, under the auspices of the New Deal, FDR did some things around gold and the gold and the window at the Federal Reserve and the ability to exchange the dollars for gold just sort of rewrit policy. And you could argue for sure that that qualified as a default, because you essentially said to the holders of treasuries that you couldn't get back in exchange for those notes what you were promised. And then in the late 70s, as the IT revolution got underway, we had some technical problems and we didn't make payments in time, but folks were paid off with interest. So Secretary Yellen, Treasury Secretary Yellen has said essentially, it's May 19th, just checking the date, that we're going to run out of money by June 1st. And people are worried that if we run out of money, the government does, we're going to default on our debt. And again, the consequences of that are really unknowable. You really don't want to cross that Rubicon, in my opinion, even if you could argue, and one can argue, I think pretty convincingly, we've been spending too much money, that's a bridge too far. I think the thing that's worth pointing out is even if we get to June 1st, we're still going to have monies coming into the government, fees, permitting, charges, tax receipts, the whole thing. So the government can simply prioritize what to do with the cash flow that continues to come in, even if they can't borrow more money. So we don't have to default. There should be enough money coming in that you can pay interest and principal to holders of those bills, notes, and bonds, but the government would have to prioritize those payments over payments, say, to Social Security or government paychecks. So there would be consequences for sure, and potentially very meaningful consequences for lots of people, but you don't have to get to a default even if you don't get a debt ceiling deal done by June 1st. And the Republicans have agreed to raise the debt ceiling, but they've also asked for 4.8 trillion in spending cuts over 10 years. So we think Speaker McCarthy being able to get that passed out of the House was a game changer. And that's why they're talking, and that's why we think something will get done. Until they get something done, it'll be additive to volatility. A few more thoughts, if I could, sort of what we like, what we worry about. Economy's hanging in there. We do think recession signs are building. Inflation has rolled over. It's still too high, but it's coming in. That's great. Earnings season is just about done. Corporate America is surprised to the upside. I may sound like too much of a cheerleader for the private sector, but the resiliency of corporate America is something that I always find just astounding. Companies have a lot of cash. Most consumers are in pretty good shape too. But that's also because the job market is really hung in there, and you're starting to see some stress in the labor market. And we've reversed a lot of those meaningful headwinds that came about because of the pandemic, like supply chains and things like that. And a lot of folks are still pretty bearish on the stock market, even though it's done really well year to date. And that's a contrarian sign. Something that I actually feel good about is when a lot of people feel bad about the stock market, because it means there's cash on the sidelines. So there are definitely positives. On the other side of the ledger, if we were to get some sort of inflation shock, like a dramatic re-rating higher, we'd be in a bit of trouble, because then you'd have a higher inflation with signs the economy is slowing. That takes me back to the 1970s and stagflation. We don't think we're going to get it. There's a risk the Fed has already done too much. I think it's a reasonable risk to assume. And you've got the geopolitical construct as well, and some questions about the sort of viability of the US dollar, which we're happy to talk about. We've got to get a debt ceiling done, and there could be more banking shoes to drop. So, I mean, there's always good, there's always bad. There's still a bit more good than bad, but even if we get weakness into the back half of the year, which we wouldn't be surprised to get, it doesn't have to look like 08 and 09. You don't have a bubble like housing as you had 15 years ago. And the fact that people, I think, are so skeptical of the stock market and the resiliency of earnings means for us that even if the economy weakens, we think stocks and bonds can continue to do pretty well, and they've done pretty well so far. So I'll stop there, Lynn. Over to you. I really appreciate the time, and happy to answer any questions you all may have.
Great, thanks, Tim. We really appreciate the resources that we have available to us as an independent financial advisory firm like Tim Hollands of the world and the relationships that we have with Joe Ryan, TownSquare, Portside, et cetera. And we focus today a lot on the, as we call it, the yellow and red money discussion. These are the assets that they're managed, that are market linked. Of course, many of you have a foundation of what we call safe and secure green money. And of course, those are the accounts that weather all storms. And we use active management to reduce risk and increase returns on those assets that are exposed. So it's a good combination, and it's a proper allocation and diversification that we just want to make sure that we do the best job we can for you. So yes, let's see. Of course, our motto: give out good, good comes back. Any questions that any of you want to unmute? Feel free to do so at this time, or via the chat. Gage, can you or Brandon, can you assist with any of that electronic communication that might be going on? And let's address any questions that are there.